Yeah, if we can go ahead and just get that out, because maybe spend the next 5 seconds and go ahead and answer these quick 4 questions, and then we'll go ahead and share the results before we begin. We got to make sure that the chats are working. So let's see if everybody can go ahead and shout out what city and state they're from. I will start. Los Angeles, California. Anybody from LA? All right, we got Pennsylvania in town. Now, Violetta, is that LA as in Los Angeles or Louisiana? Got to clarify. Los Angeles, I love it. All right, let's just wait just a couple more seconds as we have a ton of people kind of coming in now. So if you just joined, we do have a chat feature on this Zoom call. Feel free to use it. Just make sure that the little blue toggle on the bottom shows that it's to everyone and not just to hosts and panelists. And you know, as we kind of go along this webinar, which is going to be a very informative one today, just make sure that you can feel free to ask questions in the chat, and then we'll try to go ahead and answer them as we kind of go along, okay? All right, well, we are at 1 minute past the hour. So what we'll do is, Katie, if you can go ahead and maybe just stop the poll, maybe share the results. Awesome. All right, so out of the many people that are participating today or attending this webinar, we have 66 people that are loan officers. We have about 54% of the people here that's been in the mortgage industry for 11 plus years. And okay, we have about 50% of the people here that's only been in wholesale for less than 3 years. Good to know, good to know. And 75 people have answered no to have you moved over from distributor retail within the last 12 months. So it looks like relatively a lot of the people here are new to being in wholesale, so welcome aboard. We have a special guest today, but first, let me introduce myself. My name is Daniel Kay. I'm Senior Vice President of PennyMac TPO Sales. And I just want to thank everybody for joining today. You know, today's webinar is going to be on understanding Schedule C income. You know, something that we often see a lot of questions on. And we're just kind of hoping that, you know, you're going to leave today's session feeling a little bit more equipped, a little more confident to qualify your self-employed client. So, you know, just again, if you have any questions as we begin, feel free to go ahead and ask it in the chat. We'll go ahead and try our best to answer it as we go. So one more thing, let me just go ahead and also mention that this session is being recorded, and it's going to be available on PennyMac's resource page within the next week or so. So if anyone that wants to rewatch it or review it after today, you know, go on to our resource page and you'll see a Power Your Business webinar section, and you'll be able to see this webinar along with any of the past ones for you to review, okay? All right, so with that said, let me introduce our good friend, Richard Laurel, Director of Mortgage National Training at Radian Guarantee. Richard has been with Radian for 17 years, almost 18, and has been in the mortgage banking industry for over 30 years. You know, seasoned veteran in the industry. So Richard has stepped in almost everyone's shoes or has done some sort of training for just about every position in the mortgage banking industry, which makes him the perfect person to be on our call today. His focus for the past 20 years has been on training technical and soft skills for mortgage professionals like yourself. So without further ado, Richard Laurel, everybody.
Thank you, Daniel, and thank you, everybody. If you missed my post on LinkedIn that I posted on PennyMax, there was a really good article. It's a little old, but I'm going to post a link to it in the chat about self-employed borrowers and why it's so important that you're in this class today, because there's a lot of them that are out there. And this is from 2024. I think they said like 33 million. So 33, I'll call them 33 million customers that are out there for you. So if you know how to, and most of them are small businesses, and we all know that small businesses like to file Schedule C, sole proprietor income. So I always say it's the one that people think is the easiest in the mortgage industry, but I always call it's the most important, because if you understand Schedule C, sole proprietor income, that's going to be your foundation for understanding partnership, S Corp, and corporation income. So what I'm going to cover with you today, and I am going to turn my camera off because my disclaimer is what I need to look at is over here. So I don't want to distract you guys also because I don't know where I show up for you. But as we go through, please feel free to type questions in the chat. If I miss it, I promise at the end I'll circle back to answer whatever I can. I am not very good at scenarios, so please hold off on typing scenario questions in there. But I been teaching this so much, I pretty much try to cover everything you might ask while I'm going through the material. But again, please type questions in the chat as we go along. And I'm going to ask you questions. So please be prepared to participate because I like to make sure that certain points get driven through to you to understand sole proprietor income. So what am I going to cover with you today? I'm going to talk about an underwriting component right at the beginning, talk about regular and recurring. I'm going to go over business structures just really quick with you, just to explain them. We are going to focus on Schedule C, but it's good to understand just a quick review about tax returns, and then we'll jump into Schedule C going into sole proprietor income. So when we look at income, we need to do a check to see if income is regular and recurring. So regular speaks to consistency. We want to make sure it's predictable and consistent. Recurring is history of receipt and continuance. So tax returns are historical. We also know that we need to predict the future of income streams for certain things at least 3 years going forward in the future. Now, with this regular and recurring thing, especially with the regular one, a lot of times you will get DU or LP or whatever AUS system that you are using will tell you only need 1 year of the tax returns. And then your underwriter will come back and say, I need 2 years of tax returns. I can promise you it's not because the underwriter is trying to deny the loan. That's an urban legend in the mortgage industry. It usually has to do with coming up with trying to establish that stability on that income. And there might be something that says, gives them, a note that they want to double check that. So when they're asking for it, again, it's to prove stability. Also, you will probably not even see you a 1 year of the tax returns in your AUS findings unless someone's been self-employed for about 5 years or longer. And it's not every borrower. It just remember it's part of risk where that message will pop up. But the 5 years is typically there. So does anyone know why it's 5 years? Type in the chat if you know why. Why is it 5 years that typically, you won't see that 1 year of tax returns unless someone's been self-employed for 5 years or longer. Answer in the chat if you know. And if you don't know, that's why you're here. You're here to learn. So does anyone know? And I will, my disclaimer with Zoom is it doesn't give me chat bubbles. So I don't know if anybody's typing until it pops up in front of me. So it is to show stability, the 5 years or longer. But does anyone know this is my hint, what usually happens to most self-employed businesses within the first 5 years? They typically fail, and that's tied to risk. And that's why the fifth year. Yep. Fail by fifth year. You got it. Hopefully they don't though. But again, that doesn't mean we're never going to see it for less than 5 years. Someone could have a really low loan to value, high credit score, tons of assets, and so forth, and it may pop up. 1 year, even though they've been self-employed maybe 4 years. But again, we look at the whole picture. DU or LP or any AUS system will look at the whole loan before it gives you that. But I just wanted to make sure that when your underwriters are asking for it, it's to get the loan approved. Also, we're talking about income here. What if someone had a one-time extraordinary expense and you're only looking at 1 year of the tax returns? You wouldn't know. So that's why the second year comes in. The recurring, when we get into that, anything that needs to recur means, I always say to validate it, means additional documentation from your customer outside of the tax returns. So if there's some kind of income stream that we have to validate that will continue, we will need to make sure that we get something that tells me that that income stream will continue for at least 3 years going forward in the future. Someone, someone says escalate. Well, I will say you do you at your company if it's escalating. I always say that typically the underwriter's asking for the extra year because they want to get the loan approved. Um, you know, to me, escalating, saying I only need one when it's asking for two is to me, I'll leave my personal opinion on that one to the side. So again, it's just to establish risk. I always say underwriters' jobs to approve loans, not to get loans denied. So when they want that additional documentation, think of it as they're trying to help you get to the goal line versus the weird connotation in our industry that says no. Let's get into business structures so I can get started going into those tax returns for self-employed Schedule C sole proprietors. So that's the one I have highlighted that's on here, but there's five different structures that are here. This last one, limited liability company, LLCs, that is just a structure of a business. There are no such thing as federal LLC tax returns. When we're requesting documentation from a borrower, it's only going to be sole proprietor, Schedule C, partnerships, 1065s, S corps, 1120s, or corporations, plain 1120s. No such thing as LLC tax returns. To help you out on this next slide, sole proprietor business. That's the one we're going to focus on here. But if you do not have, and I'm going to make sure I supply this to Katie, this is a copy of our job aid. I'm not sure if I provided it already, but I will before the end of the day. So you guys can get a copy of it. It'll be attached with the recording also. This is helpful if you don't work for the IRS and you're not an accountant. Sometimes we don't know what to request from a borrower. I always say sole proprietor that I'm covering today is pretty much the easiest one. It's 1040s because they are personal tax returns. Schedule C is part of someone's 1040s. That was what you're gonna focus on. We're gonna talk about these key adjustments and these risks to look for in today's class. But also, if you do get someone who's an S corp and you don't know what to request, 1040s, K1s, their W2s if applicable, and their 1120Ss, that's the tax returns for S corps if they own greater than 25%. So again, focusing on sole proprietors today, but you will get this for all of the businesses. And just the thing where it says, why do we ask for some things? Business use of home. Or why do we focus on that? And that's a key adjustment. I'm going to cover it in a little bit, but it's basically we don't want to double dip against the customer. Since it's already part of someone's housing expense in that debt, we don't want to keep it out of their qualifying income. So you don't want to hit someone for a debt and then also let it reduce their income from their tax returns. So when we get to that line, we're going to add that back into their income. Now, when we look at tax returns, there are primary goals for us when analyzing them. We want to look for income trends. So we want to make sure a business is profitable. So you're going to look to see that they have income 2 years in a row. So Ruben's AI is sorry about that. I'm just looking at the text, so I guess an AI assistant will be taking notes. Uh, so when going through the tax returns, you want to make sure that their income trend of regular and recurring is there. And we're also going to take a look at adjustments that they make to the tax returns that differentiate taxable income from qualifying income. Because remember, the IRS, what they consider taxable income is not the same thing as what the mortgage industry may consider as income. The easiest example to give you on that is if any of you ever won the lottery. If anyone was fortunate, well, you wouldn't be on this webinar if you won Powerball, but that's income that's considered to the IRS, and they'll get taxed on it. If you win over a certain amount of money when you go gambling, the IRS considers anything over a certain amount, one all at once, taxable income. If you won the Showcase Showdown on The Price is Right, they would consider that taxable income. So those are things, just brief examples of stuff that might be considered income to the IRS, but not to us. We look for something that has stability and consistency for it to fall in the category as qualifying income for a mortgage. So some tips for reviewing the tax returns. Think of your application as your blueprint on your customer that's telling the story about that borrower. As we gather documentation, all of our documentation should match the information that they're providing to you. So you want to cross-check for any inconsistencies, like their name, social, and so forth. You want to make sure that you have all of the tax forms and schedules. One of the things with the IRS is the first page. I always say, think of this like a table of contents. If there's a figure on a line and there's an attachment that goes along with it, it will usually say it on the instruction, like or the line description right over to the left. Like, so for example, on line number 8, if you look over to the left of that, it's going to say attached schedule 1040 schedule 1. So if there's a figure on line 8, that means the borrower has an attached schedule 1. So all of the tax returns work the same way. You guys get PDFs from your customers, so it's pretty easy that you'll get everything from them unless they edit something out. Another thing to pay attention to is when I was a loan officer, and no offense to any of the underwriters on today's call, I used to call my underwriter a private investigator. And I used to say she would come back with conditions, and I would be like, where in the world did you find that? So one time she came to me and said, I think you have an undisclosed child support obligation. And I'm like, well, how did you find that? She goes, well, look at their tax returns. And I did have 2 years for this customer. One year there were three dependents, and the next year there were none. And I said to her, so? And she goes, well, unless they're triplets, they're not going to come off the tax returns all at once. Sure enough, when I went back to my customer, she was right. I had an undisclosed child support obligation. I know there are a lot of originators on today's call, and I always say sometimes borrowers get nervous when they take applications with you, and they may forget to provide additional information. And I'm being nice when I say forget. So my borrower forgot to let me know that they had to pay child support when I took their application. They should have disclosed it to me then, but my underwriter would always tell me as we validate someone's story, if the story takes a turn in a different direction, that means we're going to need additional documentation. In this case, it was around information about this undisclosed child support obligation. Luckily, they still qualified. So, a couple of tips on that, and just making sure that we look for the flow of information from forms and everything. Everything should come back to their first page of their 1040s, all of the numbers. I would say if you ever fill out your own tax returns, it's like following a bouncing ball. We put the same information in multiple places. So now I'm going to get into calculating Schedule C sole proprietor income. Now, Schedule C sole proprietor income, I use Fannie Mae's guide as a reference on the left-hand side of your screen because we're going to make adjustments to their income. When we make these adjustments over here, we're going to make six. We're going to start off with their net profit or loss, and then we're going to make six adjustments to their income. Although we are not going to be doing partnership, S Corp, and corporation income, I have to let you know that when we go through these, 5 out of these 6 adjustments will repeat in partnership, S Corp, and corporation income when you fill out your worksheets. Partnership income has 7 adjustments. 5 out of the 7 are the same as Schedule C. S Corp income has 6 adjustments. 5 out of those 6 adjustments are the same as Schedule C. Corporation has a little bit more, but we don't see them as much. But the ones that you do get the most, Schedule C sole proprietor, partnership 1065s, and S Corps 1120Ss, it's almost the same information that we look for on each one. It's just different tax forms and they have more, I would say, paperwork with them. So we're going to go over them and in conjunction with the Schedule C 1040. And just to let you know, even though this has 2023 on here, 2024 did not change. So I gave myself a break on not having to update my PowerPoint slide because nothing that we look for in the mortgage industry, nothing moved to a different line. So let's go over one of the first things that I get asked all the time is how can I tell, like if my borrower owns a bunch of businesses, how do I know if they started one, if one of them's brand new? Because remember, we typically look for someone to be self-employed 2 years or longer. On an exception basis, it can be one. Uh, when you look at Schedule C on letter H, it will tell you if they started or acquired that business in that year. So look for a checkbox on there. A lot of times, people who work in the same industry as their self-employed business that they start get confused, I think, when they actually started. So if your borrower was a construction worker who opened up their own construction business or landscaper, own landscaping business, they may tell you they've been doing it for 2 years, a year and a half, when actuality, when we look at their tax returns, they may not have been doing it that long. They just got confused as to when they stopped working for someone and when they started working on their own. So this will let you know if the business is brand new and just started that tax year. Now we're going to look at line number 31 on their tax returns. This is their net profit and loss. So this is a line that we look at, and let's say that the borrower made, $200,000 last year. That was their gross income. Well, when they sat down with their accountant, their goal is the same as you or I when we do our taxes, is how to reduce my taxable income. So I don't want to pay taxes on $200,000. I want to pay as little as possible. So I sit with my accountant and I turn that $200,000 into $130,000. So that's the number that we're going to have to start with in the mortgage industry. That's their net income or loss. Now, we also want to check to see if a business is profitable. You'll check line 31 2 years in a row if you have 2 years that are required in your AUS findings. If you see one year has income and the other year has a loss, don't panic because they may have had a one-time extraordinary expense. However, if this is your borrower's only business and this is negative 2 years in a row, I would be concerned with that borrower. If they're showing that they have a net loss 2 years in a row, I would be concerned. What your goal is, and my goal is for you when you analyze someone's tax returns, is how to make someone whole again. So, what can we add back into their income to get them as close as possible to the $200,000 that they made? So, the rest of the class is just going to be me going over things that the mortgage industry will look at that we may have a different stance on versus taxable income or loss for a borrower. So we're going to make adjustments and we're going to see, oh, was this an IRS thing? Oh, it was. We can add that back into their income. Oh, this was something the IRS counted as income. Oh, unfortunately, I had to take that out. Oh, wait a minute. This is a non-cash expense. They never really spent any money. I'm going to be able to add that back in. So that's what we're really doing is when you analyze someone's tax returns, you're trying to make them whole again. So we start off with their net profit and loss on your worksheets. Going to add it if it's income, subtract it out if it's a loss. The next line that we look at, it says other income. On the tax returns, you're going to find that on line number 6. Your worksheets will say non-recurring other income or non-recurring other loss. So meaning an income that does not continue. Remember, the mortgage industry, we're not going to use any one-time income at all for anything. So if there's a one-time income on line number 6, you have to subtract it out on your worksheets. Another tip for you. If you ever see a plus and a minus sign on a worksheet when you're calculating income, you're going to look at over to the left, whatever word is in brackets, that's what you'll be subtracting. Whatever is not, you won't. So that's what you'll be adding back in. So negative is brackets. That means subtract. That goes with the minus sign. Whatever's not in brackets goes with the plus sign. So I thought I saw a question pop up and then that AI assistant thing popped up in front of me. Oh, there it is. If they show a loss that is coming from 2023, but now positive for 2024, when average I get a negative monthly income, that will be a problem. I need to count that against the bout. Yes, you would. If you're averaging it out and it's negative, if it's positive one year, negative another, unfortunately, we do the 24-month average. But yeah, it would be negative. I would hope that your borrower owned another business or had a other source of income. If they own multiple ones, once you calculate the income on all of their self-employed businesses, maybe that negative, that one business that's showing a loss might be a wash because some people like to own multiple businesses and maybe one of them's losing money, but the other four are making money. Hopefully, it's making enough money to offset the loss from the one business. But yep, Carter, if you do have someone who's losing money when you do the average, they're probably going to have a difficult time qualifying. Uh, This is only looking at their income. So I always say, yeah, I can't give advice on telling them what to do or what they should do. Guidelines and programs change all the time. So I would say check with your company and see what the best way or best advice it is for you to give to that borrower who has a business who's losing money. Back to my other income though. Non-recurring other income, you're going to subtract that out. Again, that's the easy one. What if there's a one-time loss on this line? So when I was a loan officer, I had a borrower, and I use this example all the time. My borrower lost $30,000, and this was a $30,000 loss on this line. This line repeats in all of the other business structures too, just as a heads up. On Schedule C, it doesn't tell me what it is. If I took this out of my borrower's income, if I left it out, because remember we started off with their net profit or loss, they would not qualify. Found out from the borrower they lost a copyright infringement lawsuit. Great. I asked them for the documentation, a copy of the settlement agreement from the lawsuit. I put that in my file and I let my underwriter or anyone else who worked, I'll call it downstream from me, I let them know why a settlement agreement from a lawsuit was in the file and why I added that back on my worksheet. So it's not just, hey, there's a loss on this. Oh, this says non-recurring loss. It's only there 1 year. I can just add it back in. You need to get the documentation for your underwriter. And yep, Susan, thank you for your comment in there. That's why I didn't want to give advice. There always could be another program that you might be able to fit them in. So thank you for typing that in the chat for me. So again, the loan officer in me never wants to give up on a borrower. If there's a will, there's a way sometimes. Next thing that we want to talk about is depletion on their tax returns. So depletion is using up of a natural resource. So it's a non-cash expense to the IRS. So the IRS says to a business, hey, you can reduce your income by using up the bedrock company that you own, the rocks that you dug up, the salt mining company, the salt that you dug up. They have certain parameters around what can and cannot be written off. We don't care about that. We work for the mortgage industry. If they wrote something off on line number 12, that's a non-cash expense. You're able to add that back on your worksheets. Depreciation. You can work in the mortgage industry for a day and everybody knows we add back depreciation. The reason why we add that one back is that's the wearing and tearing of equipment that generates their income. It is another non-cash expense. It does not impact their cash flow to pay their mortgage. So any of their equipment that they can write off, they can, they'll do it. They'll reduce their income by money they never spent. Mortgage industry, we're going to add that back in. I have an important question for all of you to answer in the chat for me. Do you need to see depletion or depreciation 2 years in a row on the tax returns in order to add it back in? Answer yes or no in the chat for me. And I'm going to wait for a few answers to pop up. So answer yes or no. Do you need to see it 2 years in a row? Yes or no? I saw a yes, a no, another yes, another no, another yes, another no, another no. More no's. Oh, I forgot. You guys can see them all too. Sorry for reading them out to you. Um, so yes and no. So ready? Drum roll, please. The correct answer is no. It does not have to be there 2 years in a row because this is an expense, not income. And there could be a multitude of reasons why it's there 1 year and not the other year. Like James put, might be a one-time thing that they could do. Maybe they forgot to write it off last year, and didn't do it. So maybe this was the last year they could write it off and next year they can't. So the why behind it for that, like if why it's there and why it's not, we're going to be able to add this back in, even if it's there only 1 year on the tax return. So I'm glad that some of you said you thought it needed to be there too, because now you just learned another way that you can help your borrower qualify for a mortgage, because it does not have to be there 2 years in a row. Even if there's a drastic change in that, Alexander, and that has to do with IRS guidelines. Updating this class, I know more about IRS guidelines and accounting things that I ever wanted to know. The government stimulates the economy with this line a little bit. There's a thing that's called a Section 179 deduction. And just as an FYI, during our recession or whatever we're going through, the IRS will say, hey, businesses, if you go out and buy this big equipment that weighs more than this and trucks that are this or that or whatever, again, doesn't matter to us, but they say to them, go spend more money. We're going to let you front load your depreciation. So call it bonus depreciation. And that's what this 7179 thing is. So it could be really high 1 year and then low the next year. Again, for us in our industry, we don't, I'll call it, audit someone's tax returns. And again, someone reduced their income by money they never spent. If you're adding it back into their income, you are never giving them any extra money to qualify for a mortgage. So just keep that in mind. Back to my simple example of, let's say that they started off and they made, and I already forgot how much money I gave them. $300,000. Let's make believe it's 300,000. And they had one write-off. And their one write-off was on line 13, and it was $310,000 of depreciation. That would give your borrower a net loss of $10,000. Watch what's going to happen if you add that back to their income. On your worksheets, when you added it back in, let's say you added it back in, guess what it brings them back to? $300,000. We never give people extra money when we're working on our worksheets to calculate self-employed income. So don't be afraid to add it back in. So great comment, Alexander. Glad you said that, because you can add it no matter how big it is. The letter of explanation, we follow guidelines, not rules. Your underwriter could ask for one. I would, what did someone else, earlier, somebody said escalate. I would probably escalate if my underwriter asked for a written letter of explanation why they had more depreciation or not. But that you need to check internally as to what to do. You can't say, that guy from Radian said I shouldn't have to do that. Doesn't matter what I say. One more thing with depreciation before I move on to the next line. There is also business miles. Now, unfortunately, Fannie Mae's worksheet doesn't have a spot for it. You have to put it in here with the depreciation line. I know that all of the worksheets that you use, including Radian's calculator out on our website, has a spot for business miles. Every year, the IRS publishes a factor. Ooh, this is one thing I did miss on here. Um, in 2024, of course, I can't remember because I have brain cramps right now. Any of my underwriters that are on the webinar right now, or if someone can go to Radian's website and look at our calculator, I know the cents changed in 2024. Thank you, Randall. Double check it, everybody, but I'm pretty sure you're right. 30 cents. It went up a little bit. But you're going to get their business miles, multiply it by that factor, and then you can add that back to their income. This is a good spot to look at because of our, um, I'll call it pandemic, when everyone started doing deliveries of food and everything else. That way, there, we see more of this. A lot of people have dedicated automobiles for business, and they'll put their miles over here, and then we will multiply it and then add that back into their income. So I will say the trainer in me says double check Randall's 30 cents, but I think you're right. I think it went up to 30 cents from 28 to 30. It's on our calculator. Our underwriters put it on our calculator on Radian's website. Next thing we're going to take a look at is on your worksheets, it says non-deductible travel and meals expenses. I hate that it says travel and meals. It should just say meals, but they use the header line from travel and meals. What you care about is line 24B as in boy, their meals deductions. Someone said, where did it go? Why does my LOA tell me not to include business miles unless my ratios are tight? I do not know, Sherry, why they say that to you. If I was your loan officer, I would use every penny I could get to qualify my customer for a mortgage, especially the way that you guys price loans now. So I would check with them. As long as they qualify, I guess who cares? But my thing is I would use every month, every dime someone had as qualifying income when I would qualify a borrower. So check with your LOA. Back to my meals expenses. So it says non-deductible because of IRS guidelines. So the IRS says if you take customers out and you spend money on them and you spend $30,000, they don't let you write all of it off. So the IRS tells them they can only write off 50% for most self-employed businesses. So they're going to write off $15,000 on this line. The mortgage industry, they spent 30. We know they spent 30. They only wrote off 15. That's why your worksheets say non-deductible portion. So what is the non-deductible portion? It is $15,000. That's what you have to subtract out on your worksheet. Now, I know we have a lot of people on the webinar. I am not going to tell you the percentage, but I will tell you that if you originate a loan for a long haul truck driver, the IRS has different guidelines when they write off their meals expenses. They write off a different percentage. I'm not going to tell you, and I don't want anyone to type in the chat because I don't want you to remember the wrong one. Typically, it's going to be 50% on everybody. So they spent 30, they wrote off 15. We're going to just get the other half. So 15,000 would get subtracted out on your worksheets. Another thing, because I know we have so many people on today's webinar, any of you who follow the changes that are going to happen because of that big, beautiful bill thing that passed, this is a line that gets impacted. I'm not sure if it's going to be permanent or not, but they are changing the IRS guidelines. They haven't published them on it yet, but I have read that if you are self-employed and you file Schedule C and you write off meals and entertainment, the meals part of it is going to go back up to they can write off 100% of their meals. So again, keep your ear to the ground for our industry and guidance coming out on it. But it is the change that's happening to IRS guidelines to fill out this Schedule C. Um, until they come out and publish them, I don't know what, if any, guidance our industry will have, but it will change this because if someone spends 30,000, they'll be able to write off 30,000. So I all can tell that you can see where I'm going with this. We're going to need guidance from our industry. So if your borrower has, if they spent, Carla, if they spent 15, they're going to write off $7,500. Next year, no adding anything. No, 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 no. This is why I said wait for your guidance. Everybody loves to add. Remember, we start off with someone's net income after they wrote everything off. So if someone wrote off $15,000, 15,000 is already missing from their income. The reason why we're writing off 15 when they spent 30 is we're getting the other half. Just remember, we start off with their net. So everything's all in there right at the beginning. So if something changes, instead of adding, you're going to just do nothing on that line. But I don't know that. You need to wait, and we need all to wait until the IRS guidelines come out. And then if our industry has any reaction and impact to that. Same thing goes with all of that non-taxable income stuff that our whole industry, once that goes through, we're going to have to figure out how to calculate, overtime and tip income differently if that stuff is going to continue in the future. Because remember, regular and recurring, even at the beginning of this, that goes for almost every income. If some change happens to it, that change has to be lasting at least 3 years going forward in the future, or we won't look at it in a different manner in our industry. And I don't know all the answers on that. That's for a whole nother class. And after all, the IRS publishes all this stuff. So that's another line that's going to repeat in all the other businesses too. This next line does not repeat in there. Business use of home. So this is the one that was the why, a key adjustment that you make and why we're doing it. So line number 30 on their tax returns says business use of home. On your worksheets, there's a nice plus sign next to it. The reason why you're adding this back in this line for the IRS, like things like taxes and insurance are built into that. So if someone writes off taxes and insurance, you hit them as part of their debt, that would be double dipping against your customer. So you're going to add back whatever's on line number 30. However, I would say be careful with this line. If this line is a big number, you want to make sure that your borrower's house is within guidelines for what percentage they're using for business use of home. So you would take a look at the appraisal. This is also a big red flag hotspot for the IRS. People love to lie on their tax returns on this line. Technically, per the IRS, it's supposed to be a dedicated workspace, but not everybody does that. They'll write off their square footage of their kitchen when they're technically not supposed to do that. They have to have an office. But again, we don't audit people. So even if you get the appraisal in and there's no office in the house, if it's a refi, if someone reduced their income by a lie and you're adding the lie back in, you're not giving them extra money for qualifying for mortgage. However, if they lied to the IRS, you might want to keep your red flag spidey sense tuned in. Maybe they lied somewhere on your mortgage application if they would lie to the IRS on their tax returns. But again, I get questioned on, well, if I know that they don't have an office and it's a refi, can I add this back in? The answer is yes, because it's not going to impact their qualifying income for their mortgage. Remember, I reduced my income by a lie. I add the lie back in. You didn't give me any extra money. Back to we started with their net income. It's already in there. So again, this is a lie. You're adding the lie back in. You're not giving them extra money. Again, that's if you don't see that workspace on the appraisal. The last line that I'm going to be talking about with you, almost the last line, I should say, a couple of things to talk about on this one. Line 27A is what we look for on the tax returns, and it just says other expenses. All of your worksheets say amortization and casualty loss. Now, this figure comes from line 48. So first I want to go over what are the things that you can add back in. So what in the world is amortization? Amortization is basically spreading an intangible asset cost, like a cost or an expense, over the life of the asset. My easiest example to give you is I always say franchise fees. Um, I drink tons of Dunkin' Donuts coffee. If your borrower owned 5 Dunkin' Donuts and they opened up a new one last year, the IRS says, oh, you can't write off that $50,000 franchise fee. You have to amortize that over 10 years. On your borrower's tax returns, it will say the word amortization and $5,000. And the reason why we're adding it back in is because it doesn't impact their cash flow to pay their mortgage. They probably paid that franchise fee, 2, 3, 4 years ago. So the reason why we add it back in is because it doesn't impact their cash flow. But it has to say the word amortization. It's not going to say franchise fee or patent or copyright. It will say the word amortization. The other part of it, the CL, so ACL is your acronym to remember, is casualty loss. I want you to think about wind, water, fire damage, and your borrower had no insurance. The IRS says, oh, you lost all that money from that flood. We're going to give you a tax break. Mortgage industry, one-time extraordinary expense. We're going to add that back in. And the reason why I said no insurance is because if someone had insurance for that stuff, the insurance company would give them the money for the loss and make them whole again. If they didn't, the IRS is like, oh, well, we'll let you reduce your taxable income, give you a tax break, and reduce your income by that cost. So it's a one-time extraordinary expense. Now, where do you see this? How do you find that? When we look at line 27A, it says it came from line 48. Line 48 comes from part two, page two of someone's Schedule C, and you are going to look in here, and this is where it may be included. I will tell you 99% of your customers will write stuff off on this line. 99% of the time, it will not be amortization or casualty loss because this is where they write off paper clips, toner, copy paper, flat screen TVs, iPhone, iWatch, iPad, security, business gifts. This is like the catch-all thing where I can tell you, seeing tax returns throughout my career, yeah, cell phone, yeah, everything, all kinds of things can go over here. Um, Bauer had tax returns. It said miscellaneous expenses, $65,000 on one line on here. Now, I don't work for the IRS, but if someone wrote off $65,000 on one line, I probably would say, hey, what were those miscellaneous expenses? Now I'm going to flip that and I'm going to tell you, now you're the loan officer, originating the loan, and you ask the borrower, hey, were any of those miscellaneous expenses, amortization, or casualty loss? Who can tell me in the chat, what would your customer answer you if you said that to them? I'm your customer, and you say to me, hey, are any of those expenses, miscellaneous expenses, or any of those casualty loss or amortization? No, they're not going to say no clue. They're going to say, you're trying to qualify me for a mortgage and you're looking for income. So I'm going to say, yes, 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 that's they are. And then you're going to tell your underwriter, hey, those miscellaneous expenses have amortization and casualty loss in them. It won't work. It has to be written out on the tax returns as amortization or casualty loss. My accountant will let you know. I would say it's going down a rabbit hole, because I don't even want to say the word amended tax returns, oof, which is scary. Um, that could end up coming up, not just a letter from the accountant saying that it was amortization or casualty loss. But as long as I will say go down the documentation road, but trust me, I used to be a loan officer, and when you're asking customers questions, they know what we're looking for. They know when we're looking for more assets, they know when we're looking for more income. They will probably tell you, yep, it is that. That's the last adjustment on the six adjustments that we made to their business cash flow. I want to check and see if anyone has any questions for me. Again, please type them in the chat box. I mentioned Radian's calculator, so I'll put a shameless plug for our calculator out on our web on the slides. It's out there, and remember I told you, oh, the screenshot probably has the old one too. The business miles is on here. It tells you what line to look for on the tax returns. These little chevrons tell you stuff too. So I'll say if you don't have one that you don't use, or Daniel, I know PennyMac has one too. Use PennyMac's calculator. Their calculator does all the same things. It tells you lines and things, and it has that number for the deduction for the business miles too on there.
Yeah, that's absolutely right. Again, Richard,
Who's
thank you
okay?
so much. Let me see. I don't know if we addressed. I think you answered all the questions as we were kind of going along.
Two just popped up.
Uh, okay,
One of them
so
says Bauer filed 1040s 24 personal for business. That's wait, wait, I'm confused. The business was opened 8 years ago. So I think this might be where you're going. If someone changes business tax returns that they fill out, if they go from a Schedule C to a partnership or an S corp or whatever, as long as your borrower's income is still there and it's the same business. So if you go from Schedule C to 100% owner of an S corp, but now it's a different business, and you can tell that by the EIN number, that's how you would know. Or I always call that's like the social security number for a business. That will tell you it's the same business. But if it's the same, you're okay no matter how they file. Someone said brief description of depletion, using up of a natural resource. So I want you to think of like salt mining company, bedrock company, something like that. That's a natural resource that they up. The IRS has their own guidelines as to what can be considered a natural resource being used. Like, for example, oil and gas, it says on partnership and S corp returns, they cannot even deduct that. So again, that's going to be the IRS that will tell them what they can do. Operating for more than 2 years, can we use them? You can use whatever your underwriting findings tells you to use. I can't tell you what to use for income for somebody if they've been open more than if they've been open more than 1 year and it's the findings tell you need 2 year, your underwriter wants 2 years, then you need 2 years. You're welcome. I think that's, did I miss any, Daniel, that popped up in there?
No, I think we got some really good positive comments coming from people saying that this is a great presentation. Richard, you're awesome as always. So thank you for doing this. For anybody who wants a copy of this month's Power Your Business webinar, again, it will be posted on PennyMax resources page. This will be uploaded in about a week or so. So if you have any questions, please feel free to reach out to your PennyMax account executive for that access. Otherwise, check it out online. And if you're not already approved with PennyMac, please let me know. My name is Daniel K. I can be reached at daniel.kae@pennymac.com. If anybody is interested in signing up, I can definitely direct you to the right people. So thank you again for everyone for joining. Really appreciate it. We'll see you guys next month. Thanks, everybody.
Thank you.
Recording.